Which Canadian ETF is best for you? Welcome back to the channel, guys. It's me, Adam. You are watching Steady Invest, and I am really excited to share this video with you guys because it's going to be the first of many where I'm going to be talking about specific stocks or ETFs or investments in general. So very excited, guys. If you're new to the channel, welcome aboard. Hit that subscribe button as well as always, the like button as well. It helps me a lot. And drop a comment. Let me know, is there any specific investment you want me to talk about? Are you investing in Canadian ETFs? Let's talk about it. Otherwise, let's get right to it. Alright, number one on our list, we have Horizons Growth Tri ETF Portfolio. Ticker symbol is HGRO. I like to call it HGRO, and this is an all-in-one ETF, meaning it's kind of like a mutual fund where you just funnel your money into one ETF, and then it holds other ETFs underneath it. As you can see, if you scroll down to holdings, you can see that it holds the US large cap. You can see it holds the NASDAQ, international, Canadian stocks, and European stocks as well. So you yourself don't have to pick each individual one or how much of each you want. It's already predetermined for you. It's for people that don't want to spend too much time picking their own stocks. They want something that's reliable, that'll grow over the long term. That's why I like HGRO. Their management fee is 0.17%. However, the ETF is subject to fees of underlying ETFs, meaning to buy HGRO, you're paying 0.17% as a fee. These ETFs also charge fees as well. So when it's all said and done, you're paying about 0.5% for all of HGRO combined. There are two main reasons why I like HGRO so much. Number one is that it's all equities, no bonds. So if you see here, for instance, this is HGRO. You have HBAL as in balance, and you have HCON as in conservative. And the difference between all three is that the more conservative you're getting, the more bond ETFs you're holding. You can see with a conservative one, you have a bond ETF, bond ETF, bond ETF. And what this means is the more equities you have, the more risky it is. So in the short term, it's going to be more volatile. So you can see here when it crashed back in March, HGRO crashed by 29%. Whereas HBAL, or balanced, crashed 21%, and HCON, or H conservative, dropped 15%. Then let's look at the recoveries. HGRO recovered 44%, HBAL recovered 30%, and HCON recovered 22%. I look at it this way, at least from my perspective, is again, I'm in it for the long term. I don't care what happens in the short term. If I'll make more gains in the long term by having more risk right now, I'll take it. But again, that's just me. Another reason I like HGRO so much are the holdings. So you can see here in the US, they have about 55% exposures. You have the US large cap companies make up about 33%, and then you have the NASDAQ 100 making up another 23%. And a lot of these companies overlap as well, right? But you also have the diversification and the exposure to international markets and the Canadian markets as well. So you have international here, the Canadian market, and the European market. But if we go to BlackRock or we go to Vanguard's all equity portfolios, their fees are similar. However, the holdings I don't like as much. They're not bad per se, but I like HGRO's more because they have more US exposure and less Canadian exposure. So you can see about 47 are in the US versus the 55 we had. 23% in Canadian stocks, and the international gets a little bit more as well. Then when we go to the Vanguard ETF, they only have about 41% or 42% in US stocks, 30% in Canadian, almost 30% in international as well. There are also statistics out there as well that point to people's bias having so much exposure to their own home country. So if you're Canadian, you'd have overexposure to Canadian one. So for instance, Canada makes up about 3% of the total world's economy. Do you really want to have 30% invested in Canadian stocks? I mean, it's up to you, but for me personally, I believe most of the growth is in the US or maybe international companies, not so much Canadian. And that's because the main sectors in Canada, as I'll show you guys in a moment, are mainly financial and energy. One last point as well about HGRO is that you can see here they have no dividend. So if you hold this ETF in a non-registered account, you won't get taxed anything until you sell it. And the reason for this is because of the swap-based ETF. And if you want to learn more about that, I suggest watching this video by Ben Felix, swap-based ETFs. He'll be able to explain it a lot better than I can. Alright, number two on the list, guys, we have XEI, and this is iShares S&P TSX Composite High Dividend. In short term, this is an ETF for Canadian dividend investors. At the time of this recording, it's yielding a dividend of about 5.73%, pays a monthly dividend income, it's low cost, and it's designed to be a long-term foundational holding. It seeks long-term capital growth, meaning the equity will grow, so you'll see the 1787 will grow over time, as well as pay you dividends simultaneously. The management fee is 0.22%. And the reason I like this ETF so much is that the holdings are all stable, reliable companies that have just been beaten down by the virus. If we look at the graph, it dropped about what, 40% since the peak? Yeah, about 40%. And I believe it's good value right now. These aren't companies that aren't going to recover over time. The banks are going to recover, telecom's going to recover, energy's going to recover, and these are all really high quality companies in Canada. Similar to XEI, we also have BDY. And the reason I like XEI so much are the weightings. So you can see here financials make up about 30%, energy another 30%, and then the other 40% in the rest. Whereas with VDY, if we go to the weight exposure, we can see here that financials make about 60%, and then 40% for the rest, mostly in energy and telecom, and then the rest not so much. So it's really heavily weighted toward financials, which I don't like so much. However, if you're really bullish on the sector, why not? And me personally, two things: I don't invest in ETFs. I like stock picking, but number two as well, I'm not a dividend investor right now at this point in my life. But if I'm a retiree and I want something stable, if I had $1 million and I put in XEI, I would be investing in about 50 different companies and I'd be getting $57,000 worth of dividends every year. But again, right now I'm a growth investor. I want my money to grow a lot more before I start getting into dividends. Next up on the list, we have Vanguard's S&P 500 Index ETF, ticker symbol VFV. This is your basic S&P 500, but instead of having to convert your money to US dollars, you can buy it in Canadian. And the main difference between buying it in Canadian dollars and buying it in US dollars is the management fee. So you can see here VFV charges about 0.09%, whereas if you bought it in US dollars, you'd be paying about 0.03%. Which is about a $6 difference every year, every $10,000 you're putting into the ETF. And the reason I like VFV so much is that it's the cheapest ETF to track the benchmark of the US economy. And as we know, the S&P 500 tracks the 500 biggest companies in the US. And poor Intel had a really rough day yesterday. And like the way we have a Canadian ETF that tracks US equities, we also have QQC.F, which tracks the NASDAQ 100. We also have XQQ as well, which also does the exact same thing. The only differences between them are very negligible. So you can see since the crash here, XQQ went up 66.88%, whereas QQC went up 66.15%. Whereas QQC.F charges 0.25% management fee, XQQ will charge 0.35%. So it's really a toss-up between the two. It's up to you which one you want to pick. And if you were to buy the US version, QQQ, expense ratio would be 0.2% versus 0.25 or 0.35. And those are my favorite Canadian ETFs. Now, for me personally, I like stock picking because I believe it's more rewarding. Although it's more risky, I'm willing to do the proper research and create a proper plan in order to succeed. That being said though, just because an ETF doesn't fit my goals doesn't mean it doesn't fit yours either. They're a very low cost method to investing in the markets without having to put too much risk in one specific stock. Anyway, I really hope you enjoyed watching this video. Again, I enjoyed making it and talking about it because I really enjoy this stuff personally. And again, because I'm talking about specific ETFs and stocks, I'm really excited. Otherwise, guys, please subscribe, smash that like button, let me know if you're investing in any Canadian ETFs. I'll see you guys in the next video.